Record. Okay, hello and welcome to this MBH investor event. Now, I'm very excited about tonight's event. Like many of us, you've probably done more webinars in the past 12 months than you ever intended to do, but this is a webinar that I look forward to immensely. So I've been lucky enough to done probably 2 or 3 webinars with you, Mark, over the last year or two. And so Mark Matthews is the head of research for Julius, Baer, and every single time he does a presentation, normally ends up confirming some of my beliefs and driving massive trucks through through other beliefs that I have. So it's always fascinating, always very interesting to learn these other insights from around the world and different industries and viewpoints. So we'll get on to that. So Mark is going to very kindly give this presentation for about 30 minutes. Then I'm going to share for our MBH investors and others. You may have noticed we put out some research yesterday, which has been widely picked up by the media, which is some research that we did early in April with a whole lot of investors from the US and from Europe, Germany, and the UK specifically. Between them, they've got about 500 billion in assets under management. And some really interesting stuff came out that I will just run through, and I'll get Mark's opinions on that. Now we're going to do what we did with the last webinar, which is if you have any questions or comments or anything that you'd like to share, rather than put it in the Zoom chat box, if you can put it in the LinkedIn link, which is currently in the chat room, and that will allow other people to see your comments, see our answers, and we can keep this discussion going even after the webinar has finished. So hopefully that will then be a useful asset for others, and we'll put that the recording of this video in that LinkedIn thread as well. So without any further ado, I'm going to hand over to Mark. Mark, thanks again so much for your time, and I'm really looking forward to seeing this presentation.
Well, Callum, thank you for the generous introduction, but I wish you hadn't given it because I think I'll be very underwhelming after what you just said. Let me get cracking. Well, it's true. But anyway, I have too many slides for 30 minutes, but I promise I'm going to do it in 30 minutes. And that means I'm not going to dilly-dally, but just by means of summation, there's still spirit in the market. It is a bull market. Yields are contained. Bitcoin and Ethereum at new highs show you people are willing to speculate, and the NASDAQ will be up one day and the Dow down, and then the next day the Dow will be up and the NASDAQ down. So there's this big tug of war conversationally between growth and value, but ultimately all boats are being lifted, and I think they'll continue to be so. And to put some meat on the bones of that argument that I just showed you, I'm going to now show you some slides. And so here, let me start with COVID, just to show that in America, vaccines vastly exceed confirmed cases. And we know that the vaccines are working because various studies are showing us so. For example, in Texas, population sample here, you can see they found that the people who were not vaccinated were really the majority of the people who were getting COVID. Partially vaccinated, there were still some getting it, but if you had 2 jabs, then you weren't going to get it. And there is some controversy over Astra and J&J. Let me just say, not meaning to belittle the seriousness of blood clots, but if you put it in perspective, Astra, for example, and of course, hundreds of millions of people have already received the Astra vaccine, over 20 million in the UK. Then you can see on the left, your chances of getting blood clots is 4 out of 1 million. That's a study done in Europe as compared to much higher numbers for birth control and smoking, and of course, getting COVID itself. So as I said, over 20 million of the roughly 60 million people in the UK who have received vaccinations did get the Astra jab. And you can see that cases in the UK are basically down to extremely low levels, as they are in the US, as they are in several other countries that have been particularly aggressive on their rollouts. So these countries are starting to open up. And on Monday, the pubs and restaurants in the UK return to 7 days a week, full hours of operation. And they are starting to create channels for people to travel overseas as well. And in America, they're opening up. And I won't read all of these, but just to give you little samples of the progress that's been made. Godzilla versus Kong, biggest box office hit since COVID began. And I think all of you will remember around this time last year, we never thought we were going to go back to a movie theater, but people want to go back to movie theaters, and that's a very encouraging sign. The World of Concrete will be the first convention to start in Las Vegas next month. 2 months from now, excuse me, and that usually attracts about 60,000 people. Delta were the last airline to stop blocking the middle seat because they think that by the 1st of May, 65% of their passengers will have achieved, will have had the jab, and then going on, hotel occupancy 59% in America. They're reopening the Peninsula, the Mandarin Oriental, the Ritz-Carlton in New York City. Friends, the movie, this TV series from the 90s that they were going to do a remake of last year. It had to be postponed. Well, they've filmed that reunion of the Friends cast. And last but not least, Olive Garden seeing more same-store sales than even before COVID. So these are possible because the UK and the US really messed up on the actual containment of the epidemic last year, but they have been super duper with their vaccine rollouts. And unfortunately, you can't say the same for every country. So Canada, where I happen to be from, you can see is vaccinated a much smaller percent of its population than those two. And therefore, for the first time ever, COVID cases in Canada per 100 people are now surpassing those of the United States. And Canada is only 37 million people. And once the Americans have vaccinated themselves, they'll give what's left to Mexico and Canada. I think that's going to happen very soon. And there'll still be, hundreds and hundreds of million doses left after that they're going to give to other countries. But if you look at obviously this tragedy that's unfolding in India, where I think they did 200,000 new cases today, in Brazil and Pakistan, Iran, Turkey, we're seeing rises in many, many countries around the world. And I won't try to, I shouldn't even say but, because it's a horrible, horrible thing. What it is doing is it's handing on a silver platter to the Federal Reserve an excuse to keep the rates low and the quantitative easing in place. Indeed, on Thursday last week, Jerome Powell said viruses don't respect borders. Until the world is vaccinated, we can't really resume activity with confidence. He is also continuing with this very progressive doctrine of the Biden administration, which has interestingly become part of the economic platform as well. So he said there's still 9 million unemployed people compared to this time last year, and we're going to wait till all those people have their jobs again before we take away our policies. And so this is a major change that COVID was the catalyst for, which is that governments are now involved in stimulating the economy. My whole life, I was raised on the doctrine, to quote Ronald Reagan, that governments are not the solution to the problem. Governments are the problem. And now we're swinging back to a more Lyndon Johnson, FDR type of big government. You can see, talking about FDR, here's a quote from Bernie Sanders: like Roosevelt understood in the Great Depression, Biden understands the series of unprecedented crises we face today, and he is thinking big and not small. And this is a great way to win votes because, for example, United, we're going to fire a whole bunch of people, and so was Amtrak and the public transport operators in New York City and Washington, D.C. They're all saying, oh, thank you, President Biden. We were going to fire all these people. And now, because of your rescue package, not only are we not firing them, we're going to hire back people that we'd already let go. Now, I do think it's true the divide between the rich and the poor has become extreme in America, particularly when you look at the wealth of the top 10% versus the rest of the population, and then compare that to other countries around the world. And so this is a big part of his platform. And here you can see fiscal stimulus as a percent of GDP in various countries, the US on the top, versus 2019 GDP. So Trump was the pink and the green parts. Biden is the purple part, the American Rescue Plan. And this is creating a tremendous amount of money floating around in the system. You have to go back to 1944. This chart goes back to 1960. You have to go back to 1944 to see this kind of money supply in the United States, 26% increase over what it was this time last year. So it's a very different response from the global financial crisis. In the global financial crisis, Obama spent, I think, about $800 billion. And his fiscal stimulus is the gray bar in the left-hand side of this chart. So it wasn't enough to breach the output gap, whereas this time, the fiscal stimulus that Biden is providing is something like 3 times the output gap. And the last time you had such a rapid closure in the output gap, I mentioned him earlier, was Lyndon Johnson. And when he took over his Great Society, combined with the escalation in Vietnam, the output gap on the top closed very quickly. And that was accompanied by some inflation, which is the chart on the bottom. Indeed, if you look at the revisions to GDP growth in various major economies from the beginning of the year until today, America stands out. All the other ones, frankly, except Canada, have gone down. But here's where I want to say it's not a done deal that we're going to get inflation, because if we look a little closer, what we see, the dark blue on the far left is this American Rescue Plan. And it will wane in 2022 and 2023. And what will replace it are the American Jobs Plan and the American Family Plan. And those two plans are quite material, but they are spread out over around 10 years, point number one. Point number two, it is not a direct fiscal injection into the economy, sending checks to people. No, it's improving schools, improving healthcare, improving infrastructure. These are wonderful things, of course, but they don't have that direct transfer that the rescue plan did. And most importantly, you see there's some brown on the bottom. They are being financed by tax hikes. The rescue plan is not, but the family plan and the jobs plan, to pay for those, Biden is planning on raising capital gains tax, income tax, and corporate tax. And so the net impact of these stimulus programs is the purple diamonds. And so you can see it will go down and in fact turn negative around 2025. And I know that they're talking big about the stimulus, the infrastructure spending, but frankly, if you look at what he's committed to in his infrastructure plan, because it is spread over 8 to 10 years, it's the dotted line on the bottom right there. As a percent of GDP, actually, this infrastructure plan is not going to be incredibly powerful the way they were back in the 1960s. And so when we look at GDP growth in America, it's the purple bars in this chart, and this year's on the left and next year's in the middle, and the year after that's on the right. So yes, it's going to be higher than the rest of the world because of the stimulus plan, but then it will kind of go back to being what the rest of the world was like. And so therefore, when we look at the Fed's inflation forecast, which is on the far right of here, and you see that they're not really looking for much of a pickup at all in the personal consumption expenditure index, which is their favorite measure of inflation. And you think, well, how can that be possible? But maybe it will. And our own forecast to Julius Baer is very much the same. We are looking for the inflation rate to jump in the second quarter and third quarter of this year, but you can see then moderate back to about a 2 to 2.5% level in next year and the year after, which is precisely the kind of level the Fed wants. They'd probably like to see it a bit closer to 3, frankly, but they want to see sustainably above 2, and that's what we think we're going to get. Now, I'll just say that there are some very smart people who totally disagree with that view, like Larry Summers. Larry Summers says this is going to cause huge inflation. And there's a few things that are tricky about inflation. For example, the way that property is included in the consumer price index in America is based on rents. Rents are falling. because a lot of people lost their jobs. But property prices are moving higher. In fact, you can see here they were up 12% in January, the biggest move in the history of the time series. Now, part of that is because of low mortgage rates and a recovering economy. The other thing is that inventories are at an all-time low. There's only 1 million residential units for sale in America today. The average over the last 40 odd years is about 2.5 million. And so new homes need to be built, and most homes are made out of wood in the United States. And they also like having big patios in the back. So you can see lumber prices have gone through the roof, as have other commodities, but that's inflationary. And we are seeing such a fast return now to global trade that the freight routes can't handle it, the container shipping routes. So you can see on the top left, delays in delivery, and over on the top right, backlog of orders. On the bottom left, inventories are down, and manufacturing prices are rising. So all of these are telling us some inflation's coming. Probably, to my mind, though, the biggest thing that tells us inflation coming is the factory gate prices in China, which is the red line, and they have gone up very sharply. Why do I say it's the most obvious thing to tell us inflation is coming? Is simply because China is the largest producer of consumer goods in the world. And so this is telling us that prices are going to go up. And the reason behind that is the same as lumber, because semiconductors, oil, the whole gambit, commodities are moving higher. And indeed, if you look back to 1975, what correlates best with inflation, if you're a believer that inflation is not going to be just transient the way Jay Powell says it is, but actually going to be stickier, then the kind of things you want to own are commodities, real assets, real estate, and other kinds of real tangible things. Stocks are the turquoise parts there down toward the bottom, large cap, small cap. They don't correlate as well to inflation. But there are stocks that do like inflation. What happens with inflation typically is that treasury yields rise. And if you are looking for stocks that do well on the basis of treasury yields rising, the treasury yield now at about 1.6, we're looking for 2% by the end of the year. They would be on the bottom right. Energy, small caps is the Russell 2000, value stocks, financials, topics means Japan, industrials. The thing is that a lot of those have already moved. So the question is, are they going to keep going higher? My inkling is yes, they will. They've already moved a lot, but there's some strong structural dynamics for them to move higher the way that China and America in particular are going to grow this year and next year. And so here's another smart fellow. I mentioned Larry Summers, former Treasury Secretary under Bill Clinton, but Jeff Goodluck, the so-called bond king, also looking for sustainable inflation, and he says, I'm very bullish on commodities longer term. Let me move to markets and show you the major asset classes as represented by exchange-traded funds in New York, their performance over the past 10 years and year to date. So what has been best is the cryptos at the top, and then US tech stocks and US large caps and US small caps. So the last 10 years have been very good for the United States. Indeed, once again, you can see it's been the best performing stock market in the world over the last 10 years. Why? The answer is so simple. It's because they have a technology sector. Imagine if you stripped out all of the FANGs and the other wonderful growth stocks there, and you had some kind of S&P X tech. It would be General Electric, Bank of America. It would be boring. It would look like what stock markets have done everywhere else, frankly. Now, laterally, it really only started about 3 years ago. China has developed a very big tech sector as well. And I think over the next 5 years, some other countries will. Like India, for example, but the US is the tech giant for now. The bull market that we have here since 2009 is getting a bit long in the tooth. You can see the two others that preceded it didn't last a whole lot longer than this one. However, the big one of the 90s, that went up a lot more than this one. And there are two ways that you can value stocks. You can look at them relative to their history. Yes, they're very expensive relative to their history. You also should look at them relative to the bond market. And when we look at the equity risk premium, the excess return of stocks over treasuries, actually, it is not at an excessively high level. It is above its long-term average, but I wouldn't say excessively so. And this is frankly the main way you should look at equities, not relative to their history. You have to look at them relative to bond yields. I do think we can have a bit of weakness in the short term. Here you can see from at the bottom after the pandemic began in March of last year, over on the bottom left, that's the 23rd of March was the bottom of the S&P, and it went up 78% from there to 12 months later, the 23rd of March this year. Now, very rarely do you get 12-month returns of that magnitude. It doesn't happen often. Most of the time, the stock market's giving you return, as you can see in the middle, clustered about -5 to 20%. These returns of 75% or more, you really have to go back to the 1930s to see them. But if you take those times when you had months, to be specific, each one of these dots is a month, when you had returns of in between 70 to 80% over the last year. So the axis from the left to the right is showing you the 12-month return of the stock market. And I've put in the yellow, do you see 70 to 80%? That's the place that we're in now, because from those 12 months of March 23rd of last year to March 23rd this year, it went up 78%. So we're in that. And now I want to show you the little dots are what happened to the stock market after it went up between 78 to 80% over a 12-month period. What happened to it over the next 3 months? And the answer is that most of the time it went down. Not all the time. I think there's sort of around, I don't know, 8 dots. I counted it earlier today where it was up 3 months later, but there's around 30 dots where it was down 3 months later. So as I recall, the odds were about 87%. Another thing to look at is Bank Credit Analyst runs this equity capitulation indicator based on the breadth of the market, trader sentiment, buy-sell ratio, momentum. Anyway, where we are now, the bottom right there, the circle, is at a very elevated level and historically has corresponded to declines as well. There's nothing wrong with a decline of 5%. You can see since the end of the global financial crisis, they've happened very frequently. Just to play the devil's advocate, I'll also point out we had an extremely strong first quarter. And in the past, going back to 1951, when you had a first quarter return of 5% or greater, then the returns for the next 11 months of the year, which is the column on the far right, were actually positive in almost all times. I think there's around 20 rows here, and only 2 of them, as you can see, were down. So that's a bit of a spanner in the works for the short-term weakness argument. I don't try to time the market. I think it's going up more. Why? One thing is the participation in the market is very, very positive. 95% of S&P 500 companies are trading above their 200-day moving average. I know that might sound counterintuitive. You might think, well, that's a bad thing. It's not. What you don't want is just a little handful of tech giants driving the market up. And if 95% of S&P 500 companies are trading above their 200-day moving average, what it means is the whole market is very confident that we're going to have a very strong economic recovery. The first quarter results are coming out this week. They're kickstarting with the big banks. And here you can see the progression of the consensus forecast for first quarter results since the end of, since the beginning of December last year. That's the column, that's the bar on the far left of this chart. So back in the 9th of December, the consensus was looking for 11.7% earnings growth for the first quarter of this year. Now it's looking for 20.6. I tell you, we think it's actually going to be about 28 based on the macro indicators like the purchasing managers indices. And beyond that first quarter, you can see the second quarter is going to be amazing, because that's when the pandemic, of course, was the worst in America. The thing is, the market is smart. It prices things in before they happen. So if you look at the relationship between Disney and Netflix, so this is simply representing Disney's share price divided by Netflix, the market started pricing this in back in September. And now, indeed, Disney is saying they're opening up Disneyland in California, et cetera. But it's not outperforming quite as much anymore. So in fact, we're seeing a little bit of rotation now back toward those technology companies. In fact, Facebook on the bottom was the first of the FANGs to break to a new high a few days ago. And I think that's representative of the broader tech sector, be a Baer of Facebook. And so commensurately, the materials, which are very, very cyclical companies, they've done so well that on the left-hand side, you can see their relative price to book value compared to the broader market is now back up touching almost one standard deviation above its long-term average. So we would actually suggest people to not be so much in these cyclical recovery stories. And as boring as it sounds, what's really cheap right now, and we think will do quite well, are the consumer staples. And why do I say that they're boring? Well, it's companies like Kimberly-Clark, Procter and Gamble. How boring can you get? But look at how cheap they are relative to their long-term history. The price to book value on the right, the price to earnings on the left, relative to the broader market, well below one standard deviation of their long-term averages. And if we're right that the cyclicals are going to roll over a little bit, the materials versus the defensives like the staples, then actually that would infer a lower treasury yield over the next couple of months too. I said the treasury yield by the end of the year we think will be at 2%, but maybe over the next couple of months it'll back off a little bit. And that might not be a bad thing, because if you look at the rate of change in the treasury yield, which is the red line at the bottom, in the past, when you had this kind of very sudden move, like we've had since August of last year, it was accompanied by some kind of market event, from the 1987 crash on the left to the taper tantrum on the right. So all we've had so far is Bill Huang's Archegos fund. And when you look at the credit market, usually that's the first place you smell smoke before you see the fire, is in credit spreads. And they have remained rock solid. So all of this adds up to me to be a pretty conducive market still. And we can argue back and forth about, is it going to be growth? Is it going to be value? The simple way to solve that is simply to own both, because one of them will outperform. I don't know which one. I think on a 5-year view, definitely the growth. But maybe over the next 6 months, it could still be the value, because the value's got that whole recovery play that could take it higher. Now, let me just close with China. And China's underperformed the United States. To get back to its maximum underperformance, which was 2014, would infer about 9% downside from here. So I think we're getting toward the end of this big downside in China. There's quite a few things behind it. One thing that is not behind it, but I mentioned briefly in passing, is the geopolitics. I just don't think they impact the market. The market is totally stone cold, emotional, unemotional. It doesn't care about wars and things until they happen. And so it doesn't, I mean, I will point out though that Americans' favorable opinions of China reached a high of 72% over on the left in 1988, down to 20% now. And there will be a steady ratcheting up of the sanctions, and there will be, it will be unpleasant. But ultimately, I don't think, I mean, money just wants to go where returns are high, and returns are high in China. Standard Chartered does a survey of small and medium-sized enterprises. Their outlook is picking up. The demand for loans among small enterprises is also robust. But this pullback in China has occurred not because the economy is bad, not because people are worried they're going to invade Taiwan, which, by the way, I don't think they would, because you don't broadcast so obviously that you're going to invade the way they've been flying airplanes in Taiwan's airspace and things like that. I mean, if you just think back to previous invasions, I don't think usually countries make such a big song and dance about it. I hope I'm right. Anyway, what I do want to say, though, it's self-induced, because number one, the Chinese authorities are worried about side effects from this massive financial asset bubble that they see overseas, and they are worried that money will flow into China and create a similar situation there. They're also worried about the rise in commodity prices and how that's increasing the factory gate prices that I showed you earlier. So they've been taking a little liquidity out of the system through their open market operations. But not very much, frankly. I don't worry too much about sudden U-turn in policy in China. I think they're still going to be accommodative. And in fact, the month-on-month loan growth numbers show us that. So the turquoise are the 2021 numbers. Obviously, there's only been 3 months this year where we have loan growth, so it's just the 3 bars on the left there where you can see the turquoise. But my point would be that, yes, the month-on-month loan growth in March was lower than March loan growth in 2019. 2020, which is the purple bar. But it's higher than what it was in 2019 before the epidemic. And I think it's also a sign, therefore, they're not draining lots of money out of the system. There is an issue in the credit market. There's been an increase in delinquent and defaults. They're trying to make it a more efficient and market-driven credit market. And now they've stumbled on this monster, which is Huarong Finance, which it has about $40+ billion in liabilities and only about 20 billion in assets. And long story short, I think they will find a way that some of the more, what do I want to say, peripheral debt, like perpetuals and preferreds will get zero. But I don't think that everybody's going to get zero, because it would simply drive up the financing costs for corporate China, which they don't want to do. So most people will get, let's say, 50% back, and then the really senior credit will get maybe closer to 100 back. Ministry of Finance on 61% of this thing, but it's taking up a lot of the news wires right now. And it's a long conversation, but suffice it to say that I think they have the wherewithal to stop it from becoming systemic. And I think they will do that. And then there's the crackdown on the technology giants. And so this started in late December, and you can see the retracement in the growth stocks there, and huge outflows in the technology ETFs in China as a result of that. And that took the broader market down, because the top 6 technology companies are 40% of the Chinese stock market. I think the worst is behind Alibaba. I don't know how much it's down. I think about 30%, but they got slapped with a fine last Saturday, and they wrote this very obsequious letter saying we couldn't have achieved our growth without sound government regulation and critical oversight, and for this we are full of gratitude and respect. Thank you for cracking down on us. So anyway, but I think that's a buy signal. The worst is past Alibaba. Not so sure about the others. Ladies and gentlemen, I'm done. I've got one last slide on gold, but for what it's worth, gold has been a disappointment. I think largely been overshadowed by the cryptos and the fact that COVID is going away in large parts of the world, and the dollar has been strong. I would just say, though, it looks like it's finding some support here. So Callum, thank you very much. I'm going to hand it back to you.
That was awesome. I always get to the end of your presentations, I immediately just want to rewind and watch them again, because you cover such a wide range of stuff. So that was great. It was fantastic. And I know some people have been posting questions. I think you actually answered most of the questions that people asked as we went along. So inflation was one of the questions. And yeah, I mean, interesting to see your comments around tech playing a part in the Chinese markets. I hadn't realized it was quite such a significant part, and that sort of is that fairly sort of parallel to the US from what you're seeing?
Sorry, what do you mean by that, Callum? Parallel?
Well, so in terms, so as you're pointing out, the tech growth stocks have really driven the S&P 500 over the last few years. Has that been the case in China as well? Those tech stocks are the main drivers?
Since approximately 2017, something like that. So 10 years ago, the new economy stocks, so not just tech, although that's the biggest part, but you've also got healthcare, consumer, and what else is new economy there? Anyway, those guys, they were only about 20% of the Chinese stock market. And so 80% was old economy, like industrial, material, energy, financials. And their paths crossed in 2018. So today, 70% of the Chinese market is new economy companies. That makes it very unique. And now they're going through this tough time with the antitrust crackdown, and I think it's a good opportunity, really, at least with Baba, because it's still got so much growth in front of it. Yeah, and we when they started this antitrust crackdown, there was so much noise. When it ends, it'll just end with a whimper, and we won't even know it.
Okay, sure. Well, let me move on to our investor research, and then it'd be great to get your views on that. But certainly, a few of the things that you said were very interesting to me when you're talking about the boring companies that hopefully poised for a bit of a comeback. MBH, as I think you know, we have a lot of, we pride ourselves on our boring old economy, small businesses in the group, and certainly what we're seeing from the companies in our group is very, very positive, very, very buoyant on this year. I think of public record that almost every company in our group is currently recruiting. And I was talking to one of our principals today who they've hired 50 employees just in the last 6 months. Now I know Amazon have hired 500,000 employees in the last year, so 50 employees doesn't sound very much in comparison, but in the small business world, hiring 50 employees in 6 months because you got the business to do so is very, very positive. So that was the education sector in the UK. But let me take you through this research that we have done. So we've been periodically doing research over the past year. This survey was conducted in early April, and as I mentioned before, the investors that we surveyed, all professional investors with nearly 500 billion in assets under management from the ones that responded. So this is where it's kind of interesting to MBH is around micro, small, and mid cap outperformance. So you mentioned that the S&P was up 78%. So this is taking the average growth of 10 indices in Europe and the USA. Micro caps up 91%, small caps up 74%, mid caps up 58%, large caps only up 45%. But as you alluded to, those sort of returns are pretty spectacular. So quite interesting. Is it you kind of do you follow much in the sort of the micro and the small end of the world?
Not really, Callum. I must confess, we do have an overweight on the small caps now because of their cyclical attribute, but it just we don't have the manpower really to cover them. There's, as you know, many thousands. We're not the only ones.
Yeah.
They do tend to get a lot less airtime than the big companies because it's just as hard to analyze a small company as a big one, really.
Yeah.
And so yeah, they tend to be a bit neglected.
Yeah, and we'll get onto that in a minute because that was one of the things that came out. So this is talking to the investors. So 75% of the investors we spoke to believe that the micro and small caps will outperform over the next 6 months, with 17% believing this increase will be significant. Now, given they almost doubled the kind of the large cap, be interesting to know what that significant percentage is. But so 86% seeing microcaps as an attractive investment today, and 72% indicating that they will increase exposure to this class over the next 12 months. So obviously that's most of our investors are quite comfortable in the microcap and the small cap world, and ultimately, what as a holding company of small cap companies, we're doing a lot of that research for them and the filtration of the companies that we bring into MBH. So looking forward and addressing your point is, if you believe that these micro caps and small caps are going to be attractive to invest in, how do you find them? And so like yourself, you mentioned that they are pretty well hidden. So 58% believe it's getting harder to find the hidden gems due to reduced coverage from analysts and brokers. And I know we actually have some analysts joining us today. And I know that they're doing their darndest to get the news out to the masses, but it's quite tricky. 29% are expecting it to get even harder in the coming years, and 34% expect the cost of that research to go up. So I think that's kind of we invest quite a lot of time and energy in trying to bring awareness to that market, but it's clearly investors are aware that it's tricky to find those good companies. But there's some great resources out there for people that are interested in microcap investing. And then we asked those investors about the broader economy, and this is perhaps where it might go in with some of your findings. So interestingly enough, the US was the most positive, with 49%, nearly half of the investors believing GDP growth will outperform IMF prediction of 5.1%. UK was down at 37%, and Germany down at 34%, believing that GDP growth will outperform a lower prediction of 3.5%. What's your take on that? Is that American enthusiasm and typical enthusiasm from Americans and versus more staid German approach, or do you think those investors?
No, I mean, I think it's the rescue plan, right? So I had one slide I showed you earlier. Fiscal stimulus is a percent of GDP. And America is about 25% of 2019's GDP was just plowed into the economy, and I don't remember what Europe's was, but it wasn't anywhere near that. So it's the fiscal response that's that. But I also think that there's a dynamism to the American economy that very few others have, which is a function of the fact that it's just more of a capitalistic society, and the more you got to do it yourself sort of thing. So they don't have the same social contract and accompanying welfare programs that the Europeans do, that frankly drag down the European growth because it means the tax is so much higher.
Yeah. Well, one of the interesting things that we've kind of been tracking over the last 6 months is there seems to have been in Germany, which is our home market listing. We're also in New York on the OTCQX there. But Germany's had a lot of younger retail investors going into the market in the last 12 months, which I think has been seen in the US, and I haven't been tracking it, but I'm sure in the UK as well. And certainly there was a while ago, there was quite a lot of talk about Robinhood being responsible for a lot of some of these high growth in stocks, even though the individual accounts are very small. There was a combined amount of them. What's your view on that, the Robinhoodification or gamification of share trading?
I don't think the relevance is a direct one, but I think it signals a very interesting thing, which is the arrival of the Zillennials as investors. And I believe I'm very, very bullish on Zillennials, but I'm too old to understand the way they think. And a friend of mine who's 100 times smarter than me in London, he told me the other day, he's my age, I'm 53. He said, I don't hang out with people our age anymore. I only hang out with young people. Number one, because they're so much more optimistic. And number two, because I want to know what they're thinking, because they're really the ones who are going to be driving the economy, certainly by the end of this decade, probably well before it. So punting GameStop, but I think that is just a small derivative of the tremendous mindset change that these people have. And we see it in the adoption of vegetarian lifestyle and other kind of ESG friendly things that they're doing. Their willingness to treat digital as an asset class, be it Bitcoin or digital art. And to me, what's most exciting is their great desire to be entrepreneurs. You know, when I was 25 and I got my first job in finance, I mean, nothing I wanted more than to join a big, important company, to have that name on my name on a name card, you know, of a big investment bank. And I don't think they're like that at all. These people, they want to be entrepreneurs. They have that drive. It's so exciting for the economy. It's so exciting, and with the digitalization of the economy, it's so much more possible to be an entrepreneur today. So those are my 2 cents on that, Callum.
Yeah, no, it's interesting. And one of the things that we noticed very early on was when, in the kind of the initial wave of the cryptocurrency, kind of wave back in 2016, 2017, one of the big differences was the way those companies that were selling crypto sold to the younger generation. They sold through Instagram and social media, whereas up until that point, yeah, nobody else was marketing stocks like that. And there's definitely, I noticed when the cryptocurrency, that last sort of bubble ended, that a lot of those companies then moved into touting stocks. And I think that it kind of woke up a generation to the opportunity to start investing again. So yeah, hopefully a net positive there. Interesting that your friend chooses to hang around with younger people. I choose to hang around with older people because it makes me feel young. So look, thank you very much for your thoughts. Actually, I just wanted to before this webinar, we had a quick chat about that research, and you had an interesting take on how private equity might impact the small cap and the micro cap space. Do you want to just share your thoughts on that?
Well, I know I have, it was a very off the cuff comment, but I'll repeat it. I do think that obviously crypto has emerged as a very viable asset class, but so has private equity. I mean, just 10 years ago, private equity was very esoteric, very small. It was really only for the you know, the ultra rich or the ultra sophisticated. And now with all these SPACs and so many other ways that the retail investor can access private equity, it's become a massive asset class in its own right. And so I guess what I'm trying to say is that that more type of you know, because private equity is essentially investing in companies that are not listed, so they're probably going to be younger and smaller and more up and coming. Those are similar attributes to small and micro caps. They're, you know, people want to buy the small and micro caps because, well, there's a few reasons. One is they're typically quite cheap, but another is that they can grow a lot. From little acorns become mighty oaks, and so you hope that you pick one that becomes a mighty oak. And I guess what I'm trying to say is that now through SPACs and other types of instruments like that, you have that that sort of same potential for picking micro companies that become giants, and that are so that, in my opinion, that could be you know, kind of creating a shadow over the micro caps, much like I mentioned earlier. Bitcoin seems to have replaced gold as the currency alternative.
Yeah, no, it's an interesting take. And I think, yeah, part of what MBH is trying to do is sort of be a public company that does that sort of private equity of acquiring good small companies that hopefully have the potential to grow, but with a slightly different twist on it. But one of the things that we're seeing with so much money pouring into private equity, and it's been kind of increasingly for the last decade, there are more private equity firms than ever, and consequently they're bidding up prices. So I think it's just hit 15 times as the average price, 15 times earnings that the average private equity deal is doing now, which is kind of that's in the public markets realm, which means they've lost the the typical exit route. So now they have to play more with debt and other things. So yeah, it's definitely going to be an interesting space to watch. But yes, thank you very much. It's always, I just love watching your presentations. You pull from so many different areas. Last time you managed to get Tintin into the presentation. This time it was Godzilla versus King Kong. So yeah, fantastic. And like I said, I'm going to have to rewind and watch this again to absorb some of those. So for the audience listening, do please jump over to the LinkedIn link in the chat box. Let me know your thoughts, favorite things that you learned, any questions. We'll try and get answers to you. For those of you that are already MBH investors who want to know more about MBH, we've got 25 small companies in the group. As I mentioned, they're all very, very bullish about this year. And so we've had 3 companies join us so far in 2021. A transport company, a taxi company, an engineering company, and a food and beverage company from Boulder, Colorado. And there'll be plenty more to come. If you're interested in this research that we've produced today, or attending more events like this, or just being aware of what we're up to, go and stick your email address in at mbhcorporation.com. You'll get sent a free copy of the book Entrepreneurial Investing. And if you want to take a look at our tickers, it's MBHCF on the OTCQX in New York, or M8H in Europe. For upcoming events, we have got, today is obviously Mark Matthews. At the end of this month, in a couple of weeks' time, my fellow director, Vicky Sylvester, will be running the Principals Zoom live call. That's an opportunity to meet some of the business owners within the group. But specifically, that call is going to be looking at the ESG efforts across MBH. So a lot of the small businesses have been, ESG is kind of a core component of their business and always has been. So there'll be a great opportunity to learn what businesses are doing in that and what we as a group are doing. And then we've got our annual numbers, 2020 numbers, coming out on April 30th, and we've got the annual general meeting on June the 2nd. So like I said, do sign up at mbhcorporation.com. We'd love to have you on the mailing list. And that is it. Thank you all very much for attending. Mark, thank you very much, as always, for being here. And hopefully we can do this again in a few months and see what's changed.
Look forward to it. Thank you.
Awesome. Thanks, everyone.
Bye-bye.